Hi, welcome to another episode of the Financial Freedom Podcast. I'm Steve Richardson, a bankruptcy attorney trying to keep people on their path to financial stability and independence through education. Life insurance is an important part of any financial plan. Your death can bring about financial hardship to those you leave behind without it. Term life provides a nice benefit for a lower premium, although it goes up as you get older, while whole or universal life provides coverage for a higher premium, but it grows in cash value over time to provide an asset. But apparently, that whole life policy is worth more than its cash surrender value. You can actually sell it. To tell you more about this, I talked with Rob Haynie about life settlements and how they work. My guest today is Rob Haynie, who has been a major influence on the evolution of the life settlement industry during his almost 31-year career of proactive involvement. Not only has he been directly involved in negotiating and settling several thousand contracts, he also presently serves on the board of directors of the Life Insurance Settlement Association and is a charter member of the association's PPC committee, which is charged with the regulatory and legislative activities in the industry. Additionally, he has served on both the Customer Advisory Board of ITM 21st Services and the Advisory Board of the Insurance Studies Institute. He currently serves on the Forbes Councils as well as the board of the Retirement Genius and Innsmark Advanced Consulting Group. He was also named one of the top 10 most influential people in the settlement industry worldwide. Welcome to the show, Rob.
Thank you, Steve.
As we were talking about before I hit record, and the question I'm sure our listeners have is what is a life insurance settlement?
Great question, and one that I have to answer on a daily basis a multitude of times, and that is the ability for an individual who owns a life insurance policy to sell that policy to a third-party investor. And the question is, well, why would you want to sell your life insurance policies? Well, the fact remains that many people buy life insurance for a myriad of reasons in the very beginning when they're young, starting their lives. And as they age through life and their kids grow up and they've retired, they've paid off their home, they've sold their businesses, they begin to look at their life insurance policy as an expense, and in some cases, too expensive to keep. So, what most people typically do is they'll either cash it in for the cash surrender value, should they be fortunate enough to have any, or they'll let the policy lapse in the case of a term. Where we come in is we represent them and we go out to a marketplace made up of institutional investors, hedge funds, pension funds, give you an example, who like to buy this asset like they like to buy all kinds of other assets. And in doing so, as the representative of the seller, our job is to put them in the uncomfortable position of being in a bidding war. So what we try and do is drive that price up that they'll pay. It'll be a function of how much will it cost the insurance in insurance premiums over the course of time that they believe the life expectancy, which is the second thing they'll do, is they'll determine a life expectancy based upon the insured's current medical records, no physical examination required. Ultimately, we'll get that offer as high as we can. We'll present that to the advisor and or to the consumer if we're dealing with them directly. And then it's ultimately their decision as to what to do to move forward.
So these insurance policies, these are whole life, right? Not term policies.
They're everything. So whole life is one of the policies. We sell universal life. We'll sell guaranteed universal life, and certainly a term. The reason terms are very popular right now is they can buy them on younger folks in their 60s, because at age 70 is typically when the conversion period expires, and they'll convert that policy from a term to a permanent product. Most commonly, that would be a universal life. In some cases, a whole life policy.
Okay, but it's something what we're talking about here with settlements is a life insurance policy that builds value. You know, we know whole life. We know that whole life policies have cash surrender values, but there's some equity in it as opposed to a term life policy, which I like to, you know, compare to gambling. You're betting you're going to die this year, and the insurance company's betting you won't. and next year you make another bet to see if that happens again. But with a whole life policy, you're actually building some value in it, right?
Well, that's the sales pitch. So yes, you really a permanent product allows you to overpay a life insurance premium, and that money would go into a reserve, in this case, a cash surrender value, that you can use while you're still a policy holder to
Mm,
pay premiums should you not have that money in your account that month, or to borrow against
mm,
should you need additional money that month. So there's definitely a component, and there are some will argue that you could just buy term, invest the rest. You could be taking that same thing outside the insurance policy and allow you to use it for what you want to use it for. So the most common misconception is as you build the value, and I know you know what it is, but most people don't. If they have $100,000 policy and $17,000 of cash surrender value, they think their death benefit is $117,000. It is not. It's 100. The only way you can get the 17 is if you take it out, you surrender it. So you
mm,
really give up the $100,000 death benefit, take $17,000 in cash today. So our goal is to let you not make that mistake when and if you have that decision to make as to what is the best option for you with respect to your life insurance policy. We don't say you have to sell your policy. We just want you to know what you're comparing your other options against. So I'll give you an extreme example. Recently, we were with a guy with a $10 million life insurance policy. He had $118,000 in cash. He had a lot more, but he had been spending the reserves to pay the super expensive premiums. So he was told by his advisor that his only option was to surrender the policy for $118,000. Luckily, he saw a commercial on TV, and luckily, the person who found us on Google thought we ran the commercial. So he called us up, and we were able to get him $1.4 million. So that's the value of a phone call and from doing the due diligence to see what your policy, the true value of your life insurance policy was. Those premiums were not as expensive in the eyes of the investor. The life expectancy was certainly something that they were comfortable with. And they
mm.
bought that gentleman's life insurance policy, and he walked away with a 7-figure settlement. So those are out there. Is everybody going to get that? Absolutely not. But we were the belief, we talk about a term policy. The reason that it's important to realize there's value in that is that policy gets converted, and
Mhm,
that conversion that takes place throws off another commission.
mhm,
So the advisor who's advising the client is participating in that commission as well. So he or she's making additional money. The client is getting more money than they would if they were to let that policy lapse. So it's a win-win. And I
mm,
think maybe the most important thing to understand is the reason that institutional investors like a life settlement as an investment is it's uncorrelated. So yes, there's risk. Will they get it right? Will they get it wrong? Will the guy or the gal live too long? Will they pass away too soon? There's all those things you have to consider. But the reason the investment itself they like is if something happens in the world market, so the stock market collapses, we'll just make it up and drops 5 or 6,000 points or 10,000 points tomorrow. Does the death benefit change in the life insurance policies they own? Did the premiums increase?
nope.
Did the life expectancy of the client go up? Drop? You might have
Mm.
dropped the idea of a large amount of money in the stock market. But anyway, what I'm trying to say is that's why they buy it. And they will buy hundreds, if not thousands, over the course of their investment time frame inside this space. And that gives them the comfortability that some people will die sooner than they anticipate. Some will absolutely live a lot longer than they anticipate. But like a true bell curve, the majority of people will pass away within that time frame, close to
Mhm.
around the time that they projected.
So from the buyer standpoint, let's say somebody has a $2 million policy, and that investor says, "Well, I'll give you $1 million for it." So he spends $1 million, and then when that person dies, he essentially doubles his money and gets $2 million from the death benefit. So,
Well,
and
he'll
that
double
of
his
course
money if he died, right? Yeah.
depends on actuarial. I mean,
Yeah.
how old is the seller? How long would it take from an actuarial standpoint on the average for that person to die? How long are they waiting for their money? That sort of thing. But in its essence, is it true that that's what's basically happening? They're investing 1 million to at some point get back 2 million, right?
True. So the investment not only goes to what is paid to the insurer, but then there's premium reserve. So they're going to be whatever those premiums are assigned to that death benefit, that $2 million death benefit over the time. If they die in 10 years, that's one result. If they die next year, that's another. So it just depends on the function of there's always costs over and above what they give the insurer.
Oh,
So
yeah, because that buyer is
yeah,
now paying the premiums on that policy.
correct.
So you have that it's sort of like you may have an investment in the stock market, but as it moves around, capital gains, dividends, things like that, you're paying taxes. So there's a cost of carrying that investment.
Correct.
So it's just a matter of balancing, how long am I waiting for my money? Over what period of time am I going to be paying? And you factor in, this is the premium on the policy. So this is how much I'm going to be paying over the years and how much am I going to net out when that person dies?
That's correct. And the investors in this business are very sophisticated in that they understand the insurance game. So when you bought a whole life universal life and they issue you a premium, a quarterly premium statement, they pay a lot less than that. They're paying
Mhm.
the true cost of insurance. They're not going to give the carrier additional money because what happens is those cash accumulations before you were to take advantage of a surrender value is every single solitary month they're taking money out of there for
Right.
fees, administrative costs, etc. So the life insurance industry, especially as applies to life insurance, is very healthy. You might see some signs they always print when the things are going wrong for a company here or there. And the best case I can give you is in 2008, 2009, when the government was handing out TARP money to
Mhm.
all the banks. How many insurance companies got some TARP money?
Yeah.
None.
Hmm.
AIG got some, but their insurance division was actually the healthiest in the whole company.
Right.
So that's why they have it figured out. They play the game. Think about if your business model, Steve. You and I had a business that we collected money from 100 people, and we promised them a return of X, which is their face value. So for 10 of those people, at some point in the future, we paid them back the death benefit that we promised them, but we received all those premiums to begin with. But on the
Hmm.
other 90, we kept it.
Hmm.
That's a pretty good business model. So therein lies why you wouldn't have to have any TARP money during the economic collapse of the entire world.
Yeah. So that's from the buyer's perspective. From the seller's perspective, it's kind of like instead of trading in your car, you sell it on eBay or put ads in the newspaper and sell it for more of a resale value than trade in. Or if you're trading in your iPhone for the newest one back to Apple, which is maybe a closer comparison, you're taking Apple's uh, buyback, uh, the cash surrender value. But instead of doing that, you sell it privately, put it on eBay, on Craigslist, and sell it yourself. Oftentimes, you can get a lot more. So it's not just taking the easy money. I guess you're
Yeah, I mean,
looking at your
again,
options.
we just want you to know that there's an option, and you should at least know what it is. You know what
Right.
your cash surrender value is, certainly you know what a lapse is, you know what a loan would look like and what that will cost you over the course of time. There's all these different things, the options that exist. When
Mhm.
it comes to settlements, when you go to do any one of those inferior options to the carrier, they never tell you about us,
Mhm.
even though we're regulated by the same governing body that regulates now.
Right.
It's like it's an unlevel playing field. I just wrote an article in Forbes about that, which is like, at some point you got to realize this is you're not treating the customer fairly.
Mhm. So, all right. So it sounds like it can be a very lucrative option depending upon your circumstances. And I'm sure that this option has a lot of applications. Let's step through a few of them. Uh, how can this play a part in estate planning? You get naturally having the right insurance is an important part of an estate plan, but how can what you're talking about be, make it even better, make that estate plan even better?
Well, I mean, so estate planning, we'll look at my audience typically. So up in years, and they start to look at, their financial assets, and hopefully their advisor looks at life insurance as an asset
Hmm.
and determines, do they still need the life insurance policy? You
Hmm.
know, is their net worth $400 million? Then probably they do need life insurance. They probably need a little more. But that's not the average person. So they say, so, okay, what do you need? So in many cases, people they'd like income or they'd like long-term care. Those are both expensive. So one thing that life insurance settlements have been able to produce for clients and their advisors is a windfall. So that windfall comes to them in the form of a settlement, and they go from paying out every quarter X number of dollars to buying a SPIA immediately, and they start to receive income where they take that income and use it for the purposes of everyday living, or they reinvest it and grow that annuity over time. So those are two of the probably the most common things that happen with a life sum. A lot of times they retire debt, they pay off grandchildren's college expenses, which I have two identical twin girls that could leave for college in a couple weeks. And I know that's not gotten cheaper than when I went in
No.
the 80s. So there's the great part about it is the money's yours. So you get to use it for whatever you want to use it for. So there's no cookie cutter answer, but I do think that you're on the right track. Is like, what are the financial planning rewards for looking at a life sum? Well, number one, you look good in the eyes of your customer if they were getting ready to surrender a policy for $63,000 and you're able to find them 435,000. So I think that's the real application today.
Mhm. And it fits into, as you get older, you take out that life insurance policy in your 20s, and now you're 60 or 70 or whatever, and perhaps you have already set aside investments where you're pretty much set. You talk about the $4 million estate. They've got money, and they don't need, if one of them dies, if one of the spouses dies, you don't really need income replacement, and so that's not a big deal. But if you, instead of paying these premiums and having a death benefit, which you really don't need, you can then sell it and then take that money and invest it and use it somewhere else.
Well, let me give you another example because I think I like where you're headed. So think of someone with a $500,000 life insurance policy.
Hmm.
And so there's the other situation with, well, it's too expensive. I do need insurance, but I don't need 500,000. We can split the policy into two.
Okay.
You can keep 250.
Hmm.
You can sell 250 and then use the money of the 250 that you sell to pay the premiums on the 250 that you keep. That we've done. Another option, which has become in vogue in the last couple of years, which is called a retained death benefit. And you say,
Hmm.
well, what is that? Oh, it's you take that same $500,000 policy and
Uh,
the client doesn't need cash and they really don't want to pay for life insurance, but they could use some life insurance for end of life expenses. So they say, okay, what if we give you $10,000 in cash
mhm.
just because we're going to make it's a life settlement, we retain death benefit, and we're going to assign at the carrier level
Uh-huh.
$100,000 to your named beneficiary. So when and if you pass, they will be received the $100,000 cash. You'll never make another premium payment to have that option. So that's very popular because now you're getting life insurance and you're not paying for
Well, another thought, you talked about splitting that $500,000
it.
policy into two 250s. You could really, instead of saying, okay, I've now reached financial independence. I no longer need the insurance for income replacement or death, the cost of death. But if you could split it like you described, or buy several of them, and
Mhm.
as your estate grows, as your wealth grows, then you can start piecemeal selling those policies, which over time reduces the death benefit as your wealth increases, while over that time providing you with additional capital to invest, and sort of gradually, as a step up plan with several policies or splitting one policy, work that into your estate plan.
And that's absolutely would be something that the client and the advisor would work on their behalf, because they have to be a function of, what could they handle, what level of sophistication is there, because you don't want to put themselves in harm's way to say, "Okay, we're going to buy 10 policies 20 years ago for
Right.
the sole purpose of settlement." I would never buy a life insurance policy to settle it. You know what I mean? That's just
Right.
not. But if you did buy them that way, and there are people that do that. I have clients who's, when they present us with their clients, they have like 6, 7 policies. They're not one of them's with the same company. They're all
Huh.
different. So, uh, and they all bought at different times. I guess it was, I don't know if it was the right premium for them or whatever it was, but they're out there. The bottom line is, our goal is just to make people aware that you own a life insurance policy. We talked about what type of asset that it is,
Mhm.
compared it to homes. In many cases, it's your second, and in some cases, your largest financial asset you own.
Mhm.
People don't ever review it that way. This is like, what do you mean? I don't, life insurance is only if you die. And
Right.
the answer is, we like to say that we're going to put life back into life insurance. A life settlement is actually putting the life back into it.
Right.
You had it, you no longer need it, and now you're going to take that money and you're going to use it for what you want to do. And we have had people on the opposite end of what they do with this. They bought in cars, they've gotten on a cruise ship for a year and a half and toured the world. So you don't have to be on your deathbed to sell your life insurance policy. You can be
Right.
very, very healthy. You just can be older, and there's somebody that will take a risk. There's buyers out there that like to look at people on their life expectancies, as a certain type of person. What medications does he or she take? How physically active are they? What have they had wrong with them in the past?
Mhm.
When they talk about medications, some investors don't like certain medications. They think they're bad for the client, and they buy the policy based upon those.
Wow.
Obesities and other. So there's a science in what's going on here to buy a life insurance policy. It's not to say that it's 100% accurate, but it's getting more and more accurate each and every year.
Mhm. What about, for example, and just as you're talking, I'm thinking of different scenarios.
Oh,
You have someone that is older, has one of these life insurance policies, and they start to decline, and maybe they need long-term care. Maybe they need to go into memory unit or something like that. And maybe, the best would be to sell that policy, take that money, and use it to pay for the long-term care. So
that
you're
is absolutely a one of the main reasons that this happens. So it's also, we've done a good job, not a great job, but a good job as an industry of educating the individuals at these memory care facilities, at these long-term care, at these assisted living units. So when people come to qualify, you have to qualify to get into these down here in Florida. These are not just, oh, show up and write a check. It's basically, you got to prove to them you got money,
right.
that they have used the money proceeds from the sale to get into the facility. And in many cases, now the intake individuals are asking that question when they're filling out the application, because it never used to be there. Do you own any life insurance? If so, how much is your death benefit? And then if they can't qualify, they'll contact us and we'll go through the process to see if he or she can qualify for a settlement. If they can, then the money gets directly deposited inside the facility they're going to move into.
Yeah. Or you can split it, as you can say, some of
Yep.
it in cash for upfront, and maybe then you have this life insurance policy that's I don't know how many people have multi-million dollar whole life policies, but if you split some of it and say to the long-term care people, here's money to get us started, and maybe change the beneficiary on the life insurance to, pay out the difference to pay off the balance. Now the estate or some third party might lose out on that money upon death, but
Everybody signs off. So to your point, nobody is, this is a fully transparent operation, I should say, procedure. The paperwork will mandate that the current and former beneficiaries acknowledge that this policy is no longer going to be under their control and it's being sold. Otherwise, the sale doesn't happen.
well,
So
I'm not
please,
talking necessarily solely. You talked about splitting a policy
oh yeah, yeah, yeah,
and
yeah.
selling some of it. I'm saying split the policy, take that money, that will pay for quite a bit. In return, all what's left in death benefit you then make the beneficiary the facility, and they know on the back end that person passes away, they get that benefit.
True, they have to be comfortable with the fact that the other person's making the premium payments now. So they, when
Yeah.
when that gets signed, they have to be like, okay,
Well, I'm sure
yeah,
the premium payment on that policy is a heck of a lot less than what it costs per month on a decent care
absolutely,
facility.
absolutely.
And if that makes a difference, and if you're, and I know this from experience with two of my wife's relatives, you know, Alzheimer's, dementia is a fatal disease. It
Yep.
starts with the cognitive and memory centers of the brain, but ultimately gets to the autonomic parts of the brain, and you die from it. So, memory unit, they may be there for a couple years, but they're not going to be there for a long time. And the from a cash flow standpoint, the facility making it's worthwhile, they get some money up front, and then the rest of it when the person passes away.
Right, you're right.
Now they keep the overage because they're
Yeah,
the beneficiaries, so there's a loss to the estate or the former beneficiary of the policy, but it can work for a lot of people to get
well,
decent.
yeah, the key is to get into a good facility of your choosing. Uh,
Yes.
I mean, I'm in Florida, so a state-run assisted living or long care facility for adults is, I was told at a function that you're better off robbing a 7-Eleven and getting put in jail than going to one of those state-run
Uh,
long-term care facilities.
that bad,
And,
huh?
and he was not laughing. He was saying you're better off.
Uh,
So because they're you know they're all both publicly owned, but one's more of a profit center, and that's prisons. They when you get to prison, you could be unhealthy as all as you know as you can possibly be, and they'll keep you alive, keep getting that money.
yeah. That,
So our goal is just to relieve a little bit of just to let people um, understand there's options, right?
right.
You just know what you're, don't discount it till you know what you're talking about. We may go through this procedure and we may say, um, there's no offer. You're too healthy, or your premiums are too expensive, or a combination of both.
Right.
But at least you tried. And I'm gonna,
Right.
and when we tell you there's no option, there's no option because we have
Right.
relationships with every buyer. I'm not the buyer. I only get paid if I help you secure an offer. So we
Right.
go to every licensed provider. I'm being in the business, for as long as I have, I know who everyone is. We know I have two business partners who operate most of the daily trading that goes on in these life insurance policies. And if they can't get you an offer, I mean, it sounds cliche, but it's true. You can't get an offer.
Yeah. But it sounds like there are a lot of, I mean, we've talked about estate planning, we've talked about, long-term care. There are different ways you can uh, leverage these kinds of deals if you can get them. Uh, but as the estate planning we've talked about also kind of goes into retirement planning as far as your overall portfolio is concerned, because you can, as you, like I said, once you no longer need that death benefit, you might as well take the cash out, put that into another investment that'll grow for you that you can use now rather than somebody else using it after you're gone.
Correct.
So we've also talked about with long-term care where you're now benefiting from it in getting decent care in a nice facility. But how can it also help people, overcome debt or avoid foreclosure? They're in a financial crunch. How can that help without really stripping their gears financially in the long term?
So the only way we tell people to sell your life insurance policy, okay, we tell them only you do not want to sell a policy if you need the insurance and you can afford it. So
Right.
if you need it, you can afford it. So you're talking about financial strain on individuals. If they're having trouble making ends meet, COVID taught us one thing: life insurance is a luxury. When you think about the roster of things that you need to pay for on a monthly basis to have a normal life, life insurance is at the bottom of that list. It's not the
Right.
top. Food, medicine, healthcare, et cetera, so on. So if you're going to lose the policy, because naturally the first thing you're going to give up is the life insurance premium, you're going to say, I got to keep that John Hancock premium being paid. Let's not eat for 2 weeks. That's never going to happen. It's
Right.
not going to happen. So we suggest that you can use your proceeds for whatever way means you need to use them for. So if it's debt, credit card debt, whatever, foreclosure of your home, every one of those scenarios, there's been a policy sale that's happened inside this operation for those exact reasons. Because they were gonna let it lapse. So in some cases, you had, we've had people that have had hundreds of thousands of dollars in cash surrender value and have used it all the way down to zero. So basically, they've turned a UL into a term, and they're at the end of the term, like, I don't have any money to pay the premiums. And, they didn't know the option exists. They didn't know you could split a policy. So we got to get in a situation where how much money can we raise? We're now fundraisers at that point. What's the maximum life insurance policy amount that we can get for sale, given your current? Now, we don't go into this sale talking about the financial strains on the client. We're just trying to sell the policy, get the
Right.
most money that we can. So ultimately, that's between you and your financial planner, or you and your family members, to determine what's the best use of those proceeds once you get them.
Right.
Our goal is to get them.
And it can depend upon your age and everything else as far as how saleable the policy is, as you say. You may not be able to make a deal. You may not be able to find a buyer because they're too young, they're too healthy, too far away from a payday for the buyer, and you're not able to close that deal. Is it ever just a hard no, or can that simply drive the price down? In other words, are there buyers out there they just won't give you a lot of money, but you can still make a deal? It's just
Well,
not
yeah,
a
so
good
we'll
deal.
present every and any offer. It's our obligation. We have to do it. So yeah,
Right.
we've sold $1 million policies for $8,000.
Mm,
Person was very healthy, young
right.
and healthy. But again, they were getting ready to give it away for zero. So $8,000, it's like you and I are walking out to our car from Target. There's $8,000 lying in the parking lot. We're picking it up.
Right.
So that's the reality of the situation. So as it applies to, life expectancy and age, sometimes we help people who are in their 50s
Mhm,
and 40s, but they have chronic and or terminal illnesses.
mhm.
They're going to get a lot of money for
Right.
their life insurance policy, unfortunately. Um, but that's another thing. This is how this marketplace began. It's called a viatical settlement.
Uh,
So someone that was dying, HIV and AIDS, cancer, etc., they can sell their policy at any age and use those proceeds for whatever they want. I've had a client, this is a true story, a lawyer in the 90s called me up, had a brain tumor, and he had a lot of money. He was a lawyer, was a very successful lawyer. Was dealing with UCLA. They told him there's nothing they could do. Get his affairs in order. So he sold his life insurance policies, two of them, two $5 million policies for close to $6 or $7 million all told.
hmm.
Took the money, went overseas, had some, used to make them laugh, a bloodletting, more or less, of the brain, blood inside the brain, and a bunch of like really non-FDA approved uh, clinical trials taking place in Europe.
Mhm.
Came back to the United States, he had no brain cancer. None.
Wow.
Went to UCLA. UCLA couldn't believe it. They're like looking at this guy's head, like, what the hell happened? And the reality was he had read up enough about it and certainly had the wherewithal. So in essence, we saved his life. Now, in all seriousness, the investor did not appreciate that.
I'll
But
bet.
that's not, acts of God are not something that I have control over.
Right.
But that's just to show you the power of money when it comes to saving your life. You'll do almost anything, and he did.
Uh,
And that's a true story. I mean, that was just the craziest thing in the world because he was literally told by the best doctors in California, there's nothing we can do.
well,
And
it's
he,
interesting that as a bankruptcy attorney listening to this, there's sort of the good news and the bad news in that if you have, for example, a lot of student loans that you might not be able to get discharged in a bankruptcy, but they're weighing you down. Say you might have co-signed some private loans for children, things like that. So you're older, and you just want to get out from under that debt. Something like this might help to be able to pay it off.
sure.
Uh, but the scary part is that because you in that way you can avoid bankruptcy. I mean, if your debt is mainly just credit cards, you may be better off just filing bankruptcy, getting rid of the credit cards and moving on and keeping that policy. What I worry about is bankruptcy trustees listening to this podcast, because one of the disclosures in a bankruptcy petition is, do you have any life insurance? If it has any cash surrender value, what's the cash surrender value? And you have to have the documentation, et cetera, et cetera. And there's certainly exemptions that can protect that. But if there is the capability of selling it for significantly more than what that cash surrender value is, or what can be exempted, then there might be some trustees jumping in trying to sell those life insurance policies as part of a bankruptcy liquidation.
And there have been. So when you sell a policy and there's a bankruptcy, it's disclosed. Those paperworks go to the investor. The investor realizes that what's happening, and then where they're confronted more or less and told, look, you're going to get X number of dollars. And what usually happens is both sides agree to let's let it play out, see what it's worth, and then they split it amicably among each other based upon the prior agreements. So
Well, I don't know that the buyer's in any jeopardy. In other words,
no,
the bankruptcy trustee just steps into the shoes of the debtor, says,
yeah.
I'm going to sell it. The buyer gets the money, gets the policy, pays the money, gets the policy. The trustee then gets the money from the purchase and uses it to pay creditors. But my concern is that, usually people have life insurance that doesn't have a cash surrender value that exceeds the exemption. So they're usually okay. But trustees start finding out about this stuff and saying, hey, wait a minute, there may be more money here that I'm leaving on the table. And that could hurt people filing bankruptcy, just having that option and being out there.
Well, I don't, that's maybe above my pay grade as to what the outside looking in on that is. But the reality is, you got a situation, because remember, if you're keeping the policies out there and you got to keep the policy in these bankruptcy agreements, you'll never see any mechanism to keep paying them. You know what I mean? For example, if they run out of money, they can't pay the premiums, the policy goes away.
Well, usually the life insurance premium is an allowable living expense under the expense section of the bankruptcy petition. So they continue to pay on the premium.
Number.
I'm sorry?
At a certain number at the time of the bankruptcy. Then over time, as these premiums start to escalate.
Oh, yeah. But I'm just saying at the time they file bankruptcy, as far as the analysis that's done by the trustee and everything else.
Yep.
But it seems like there are a lot of things that can help, overcoming debt, pivoting on the use of the money. As you say, that, the guy that ended up getting himself cured or just converting it to, pay for long-term care. There seems to be a lot of flexibility in these,
yeah. So when this industry first started, and I mean this like around the turn of the century, majority of the people that we're selling to is we're working with high net worth clients, because the agents were motivated by, money. They're going to help their client sell their policy and maybe even turn around and sell them a new policy. So they said, well, how could you sell them a new policy if you qualify for a settlement on the old? Well, back then the underwriting was a little different. So the life expectancies in our marketplace were not as sophisticated as they are today. And one of the reasons was they started to figure out that the typical life settler was different than the typical average American. So what does that mean? That means, well, they're better educated. They've got more money. They got better access to medical care. They tend to be more compliant. They tend to have a better support network. They have the ability and flexibility to go somewhere else for better treatment, like MD Anderson, for example, for a certain type of cancer, and they go. And as a result, took about a decade for them to figure it out. That added an average of 2.5 to 3 years to your life expectancy if you were a typical life settler, as opposed to the people that are calling up today answering the commercial from television. They're just average Americans. They can't leave their work and go to a facility in Pittsburgh if it's better than the one in Philadelphia, or vice versa. They're not as compliant. They might not have the education level. So those things typically decreases the life expectancy in the eyes of the investor. So those are things that have taken place. But the best thing I can tell you, and I think I alluded to this earlier, is they're getting better at understanding life expectancy on
Mm,
people 65 years and older. What they're going to be. Certainly people are living longer. There's no doubt about that.
mm,
But there's always, because we are people and we're fallible, we always tend to try and do things. So right now, the newest vogue thing is these peptides and different drugs that you can take to lose weight that were started out for A1C and what have you. So there's two schools of thought. Is that A1C drug, Manjaro, et cetera, helping you lose tons of weight from going from obese and now healthier? Is that lengthening your life expectancy? And to some people, the answer is yes, and others, it's not a factor.
mm,
And there's others that, are you taking too much of this? And we don't know the long-term side effects of that. So there's investors that view it, one that views it one way and one that views it another.
mm,
So I think it's a good time to be a seller in our business because you've got a lot of variety in terms of buyers. You can be younger, like I said, in your 60s.
mm,
At the turn of the century, you had to have a life expectancy probably no longer than 6 years.
mm,
7 years now, they're 20, 25 years, depending upon the cost of insurance. So it's gotten better, and I hopefully will continue to get better.
mm. So if any of our listeners are intrigued by this and thinking, hey, wait a minute, this could help me, uh, how can you help them and how do they get in touch with you?
Well, easily enough, you can call my cell phone, which is 954-599-4433, or reach me by email, which is rob@lisettlements.com.
All right. You have so they can go to your website, they can reach out to
Sure.
you and you can help them. Now, what what do you recommend people do to the extent they know and can do it to look at their policies and start considering whether it might be a good idea to do it or whether there's a good likelihood of being able to get a buyer? Are there factors they should look for in their policy and in themselves or
It's kind of a hard for me to answer that in one sentence, but I would say that if you have a life insurance policy that you no longer want, no longer need, or can no longer afford, that would be the most obvious couple of reasons why you should contact me. If you
okay.
don't know what it is you're looking at, which is, by the way, which is me some of the time, don't hesitate to call me. I'll either figure it out or have one of my assistants figure it out in terms of what we're looking at in terms
Mhm.
of cost of insurance. If you've got someone you trust, a financial advisor, I would call them and
Mhm.
have both of you call me. And we'd be more than happy to go through it with you.
All right. Sounds good. Well, thanks for coming on the show, Rob.
Oh, my
I know
pleasure.
I learned a lot from this. I didn't know you could do any of this, and I'm hoping bankruptcy trustees never find out. Uh, but great to have you on the show. I'm sure the listeners got a lot out of it, and that you can certainly hopefully help them if they need your help.
Perfect. Thanks, Steve. Thanks for having me.